As the Perth property market reached its peak, Perth was long considered the dud that missed the 2021 boom, then proved everyone wrong, and has actually gone on to be one of the top performing markets in the nation. While it's done exceptionally well, is it going to keep giving us the ROI, allowing us to actually grow our portfolio ongoing? In this episode, let's discuss 3 questions as a property investor you need to understand. Number 1, is this simply an investor-led property boom that will bust when the demand moves to other property markets? Number 2, can local affordability sustain continued growth? Number 3, what the top of the market cycle looks like and how you can actually develop the skills to spot it. Coming to question 1, is this an investor-led property boom? The short answer to this is no, but investors do play a key part in the activity rolling on. Now, when you're getting property activity in Perth, there is a lot of investor activity coming from many markets, and that's no question, but it's important to understand the why. Well, the first thing is that people feel Perth prices are undervalued. Secondly, people feel that Perth is fairly affordable. And due to that affordability, it's allowing them to get greater rental yields as well and greater returns on their money because of that. From that perspective as well, people feel that because it hasn't grown a lot, it may have more legs in it. Now, those feelings that I've described aren't just investor feelings. They can sit with owner-occupiers too. They might have been renting for a long time, seeing yields that are quite high, and are now going, well, I'm paying a fair bit of rent in comparison to the price of the property. Why don't I consider it? So that's another buyer base now considering that. The next one is homeowners who might have been considering an upgrade. Remember, there's an actual phenomena happening in Perth right now where the lower price market, and it's something that's apparent across many parts of the country, but the lower priced market is actually increasing in prices faster than the mid and upper tier. What that actually does, it brings on another wave of growth in mid and upper tier markets when lower price markets can have that larger growth to eventually upsize. And that upsize in their markets allows them to move on. So this also spurs the thinking from that owner-occupier base who are thinking, well, my lower price market's doing well. Could I now move to a different area? And there's also the job market, right? If the job market is continuing to perform well, which unemployment stays low, job advertisements are high, naturally that's going to actually impact the ability of owner-occupiers to move too. So how do you actually cut yourself a clear distinction between an investor-led boom? It's where if the local economic conditions are quite weak, that's one, because then you can say, well, local jobs, local employment, local incomes, local affordability is quite weak. So where's the money coming from? Now that's not the case here in Perth, and not the case for many markets across the country. So that means that it's a first sign that it's not an investor-led boom. The second sign is that when you're looking at finance take-up, if you go back to finance take-up across the nation and you go back to 2015, 2014, you'll see that there was a time where finance, as per ABS data, actually showcased itself to be close to half the loans amongst that Sydney and Melbourne boom that took place between 2012 and 2017. Now, I'm not saying that's all an investor-led boom, but investors played a much larger proportion in that time period in comparison to any other time period of the last decade. So that's the next part. And the third and final part is the market depth and size. There just aren't enough property investors out there to move the dial for a city of 2+ million people. Had this been a town where perhaps maybe we only had 10,000 people or 20,000 people, then one could say if investors are attracted by the yield, if investors are coming in at large proportions, affordability, all the signs could start to come together. But there's that market depth in Perth, which means that it actually is not investors. They play a part in it, but they're not the ones that simply drive it. Now, where could investors come in and make an impact that definitely is a big part of it? Well, the biggest part of it is this. If they are constantly making locals miss out, then when locals miss out, they go to the next property jam-packed with new intel. So my first discussion here would be like, hey, agent, what happened on this deal? I missed out on this. And they're going to ask, right? Because they want to know how much it went for. Oh, interstate investor bought that. Now, that naturally has a snowball effect. So it's not the singular part of the boom. It's a part of it, though. If that snowball effect is constantly locals hearing an investor beat them and an investor beat them, another investor beat them, then guess what? It's going to be something on their mind that they need to lift their game higher to eventually secure a home in their market. And that then allows for the influence of investing to play a part in it. So it is no doubt an influencer. But when you look at local strength of economic conditions, market depth of the size of the city, and then of course you also look at the conditions in play that are there for owner-occupiers and renters to take advantage of, with the upsize, the job markets, and the renters wanting to not pay that much rent in comparison to price. They all are drivers of owner-occupier activity. So from that perspective, you can look at it and say that. And state finance is pretty strong from a WA owner-occupier level. So coming back to point one, that question, is it investor-led boom? No, but is it heavily or partially even influenced by investors? The answer is yes. So when you're looking at that part, that allows you to then go, well, how does this play into the actual growth cycle and the peak of it? Well, I wanted to give you the first signal in understanding and identifying the growth signal component, and that is the local job market. So looking at some data here, I've got unemployment rates for Perth at low threes. That is extremely strong. It is stronger than the national market. Also, job advertisements, like most of the nation, have been trending up heavily since 2020, but actual Perth job market recovery was sort of 2017 and 18, which is a core part of the turnaround in that economic, fall off that happened during the mining boom. Now, it doesn't mean that mining is lost forever and mining is not part of the economy. Like, you'd be silly to look at that and think that. You can look at multiple ways. CapEx is one, capital expenditure, that is low, but it's just one element. Second is iron ore price points. Third is also general output of state revenue. Fourth is looking at jobs and actual job availability and job makeup, and then going into flow-on impacts of jobs that were connected to those initial jobs. So like it's a flow-on of the major jobs there. And the fifth and final thing, or sixth and final thing, you could actually just do a walk test and basically look at the CVD and look at the tallest buildings and go, who's fitting in those buildings and which company they're working for. Go figure. So it's not that that doesn't exist. That is there. It's just your awareness of it. Am I comfortable with it? And based on the local trends right now, everything is fairly strong, but it's just about knowing your comfort with that component of the mining economy. But that is one component to actually distinguish whether is there an actual impact from the peak and the peak cycle being reached. Well, job markets are a first trend to say that no, you're not at peak, and that is actually strong right now in Perth. The second part is local affordability. We asked that question before. Can they sustain the growth? Now, to measure local affordability, I look at undervalue and overvalue, and I'm going to bring up some insights here that talk through whether the undervalue or overvalue in comparison to mortgage repayments is an issue in Perth. And so what I like to do is I like to look at benchmarking interest rates of 5.5% and even 6.5%, because we're hovering around the 6.5% for investor rates and high fives, low sixes for actual owner occupiers. So it's a good bandwidth to look at. And what we're doing here is we're taking 80% mortgages, we're taking local incomes, and we're taking 30-year loan terms P&I and trying to see, are they using more than 33% of their income towards repayments for properties? And at what point does the 33% get reached? For example, say median prices are at 500K. Median prices have to rise 10% to 550 to allow for the 30-year term, 80% loan, 5.5% interest rates, principal and interest, to reach a local household income, 33% of that towards mortgage repayments. So it's basically saying, how much do prices have to rise? That means it's undervalued by 10%, because prices could rise 10% and you'd reach that cutoff to say, hey, your third of a household's income is going towards a typical loan via typical income to make typical repayments at 5.5% interest rates. And so if that number was the other way, prices have to fall 10%, then you would say that that is now overvalued by 10%. Now, it doesn't mean instantly that this correlates with price fall or price declines by that percentage, because Sydney's 10-year growth average is close to 8 to 10% per annum when you take a look at certain markets, right? So if you take a look at certain markets in Sydney, well, by that basis, why has Sydney overvalued throughout many years and it still grew? So you can't isolate this metric, but you can say it plays a part. In fact, you can't isolate any metric in Australia. It's just not the way to analyze property. But this metric plays a core part because you can see that repayment to income level. And so Sydney still grew, but it was overvalued for many years. So again, it's not a correlating piece in isolation. But when you're looking at this trend, what's clear is that Perth at 5.5% interest rates is undervalued by close to 20%. So it meant that if interest rates were hovering for owner-occupiers about 5 to 6% for interest rates, Perth prices could rise another 20% and still be affordable to locals. Now, what happens if that's 6.5% interest rates? Well, Perth is about 8% undervalued, which means Perth prices could rise another, almost 10%, and still local incomes, as Perth as a whole, right, could afford it. Now, what happens when you look at that metric in other cities? For example, if we go over to Sydney, that metric is 45% overvalued. Now, that's why I say you can't use this metric in isolation, but it is simply saying that local median incomes aren't perfectly aligned to house prices in Sydney. So it's not just your local incomes that are going and buying typical properties that can afford typical loans. That's not how it's placed out, because there's so many more dynamics, upsizes, downsizes, cash buys. That's why you can't use this metric in isolation. But it does show you that Perth is definitely sticking way better than all the other capital cities when it comes to the overvalue, undervalue metric, which answers the second point. Is it affordable? So now, just to recap this particular data point so you can go investigate this yourself. Number one, take local incomes as a household. Number two, take 33% of local incomes to say that's fair number of going towards your mortgage repayment. Number three, take actual median prices with an 80% loan to value ratio, principal and interest, and calculate a monthly repayment at either 5.5 or 6.5% interest rates. And then number four, how much would prices have to rise or fall for this metric to reach the balanced point, being 33%? And if the number has to rise, prices that is, to make that number match each other, income to the repayments, then it's undervalued. And if that number has to fall, that means the prices have to fall to meet those repayments that it should be at either of those interest rates, which means it is overvalued. So that just gives you an example of, how to look at that measure, which answers that second question. Can local incomes actually afford the sustained growth? And based on this metric, for it to get to Brisbane, Adelaide levels, because they're sort of similar, comparable sized capital cities, one obviously being a bit smaller, one being similar, being Brisbane. But in those markets, to get to that level that they're at currently, Perth prices could rise another sort of 25 to 40%, depending on areas, for it to then reach the value levels of those cities. So it definitely does mean, based on local incomes, there is more growth ahead in this market. Now, the third and final part, what is the top of the market cycle? What does it actually look like? What indicators do you actually say, oh, hold on a minute, this is now changing? I want to actually take you through some of the core indicators we look at. And you're going to learn the biggest thing in this particular point, so stay tuned the whole way through, because in this point, I'm actually going to go through one data point that everyone gets wrong. When they get this data point wrong, they are constantly led to thinking market cycle's over, and they go through it for another 2 years or another year. And let me just take you back to Hobart as an example, and even Sydney. Back in 2018, many would have thought Hobart would have been a market that is done with its growth, because everywhere was sort of quietening down, or many markets were or slowing down. But in 15, 16, 17, and even 2018, Hobart continued to continue on. Then the same was raised about markets in regional Australia. Between 2018, markets like Orange or markets in regional Victoria continued their growth to 2019, 20, and even 21. But then many felt that no, the booms just can't keep going. What if you go back to Sydney? Sydney in 2014 had come off 2 to 3 years of double-digit growth, and then everyone said it's over, but it continued its growth in 15, 16, and even half of 17. And it's simply because people get this one metric wrong. People simply isolate past growth, thinking that that is the only way to measure a growth cycle. Yes, a market cannot keep growing forever. We all know that. But past growth alone is not a fair assessment of this. Let me take you through an example and bring up Adelaide and Perth just to give you two variations. With regards to Adelaide, it has had a huge growth cycle over the last 3 to 4 years. In fact, it's been the top performing capital city in the nation for last 4-year price growth. So this is massive. Since the COVID pandemic hit, no capital city has been better performer for Australia than Adelaide. And even in recent times, it's holding its weight, being placed well with Perth and Brisbane as growth markets. So how do you then look at Adelaide maybe last year and think, hold on a minute, it's had 3 years of growth, why would it have the 4? Or 2 years ago, it's had 2 years of growth, why would it have the 3rd and the 4th? Yet it had it. Now, people who kept looking at past growth make this mistake. Let's just say a city was maybe a low performer, and that city was 10 years of performance reviewed in 2019 for Adelaide, as an example. Many would then go to believe, well, it has to return to its averages. It's only been averaging 2.5 to 3.5% per annum averages, but the long-term average is 5 to 7%. So if it brings it back up to its average, which it did in recent times, it actually came back to a 10-year long-term average in line with capital cities, all in a 3 to 4 year period. Now that's returned back to average, but we need to ask ourselves, has there been times where markets have outperformed the average, and after outperforming the average, they've then returned to average? The answer is yes. So, for example, Sydney and Melbourne outperformed the average from 2012 to 2017, and then they started returning back to averages between 2018 weaker performance to 2024 weaker performance. So it means that there was a period where they actually outgrew their averages. And this can happen again. For example, Adelaide might have been now returning to a 10-year or 20-year average based on this weak period of 7 to 10 years caught up with a strong period of 4. But that's now at average, which means it could go for a new run to be above average. So that could go on for another 2 or 3 years as an example. And then there'll be a slow period for it to come back to average. So you can see, you don't know if I drew this straight line across here, you could have this line here come back up to the average. It doesn't mean that now it's at average, it must just stop. It could go over the line, be above average, but then it has to come back down because it cannot keep outperforming it. So 2 things could happen. Either Adelaide just stops growing completely, or Adelaide outpaces for longer and then it really does slow down. And so that's why people keep making the mistake. It's not just this singular thing where therefore it's grown, now it must stop. It could have grown to average, it will now outperform average and then slow, or it could have grown to average and will slow. So they're both outcomes that actually showcase a slow eventually coming, but is it going to come now or in a few years later? And this is why you can't isolate price growth in past data and just simply use that. It is a big contributor because you can't keep outperforming. And you can't keep underperforming. But will it come back to average and keep going then slow? Or will it come back to average and then slow because it's reached average? So this is the unknown, and this is why we review more than a singular trend of past data. And this is where Perth's data is starting to get interesting. The first data we're looking at was affordability, which was answered in the last question. And then we looked at this next bit of data, which was actually the growth of the past. Well, the past growth in Perth, whilst very strong in the last 4 years, after the recent boom in the last 2, it is still performing extremely below a 10-year average, which means that it is likely to still continue on for some years ahead to capture all the lost growth from that big retraction that occurred in the mining boom to bust, and also to actually bring the levels of affordability more similarly to the rest of the markets in Australia. Because right now those affordability levels are extremely affordable, so that will likely continue. But the next thing is we look at a few other micro trends. When we're looking at trends, one of them here that I'm bringing up is inventory levels. Inventory levels are measured by demand and supply. Demand being sales volumes, and that's the number of deals occurring, so how much buying activity is there. And then supply being the current listings sitting and available. So if there's more buying eating up more than the average of listings coming on, then inventory reduces. And if inventory is a low level, then there's a fast pace of selling occurring. So this then drives prices up. Same thing on the other side. If less people are buying, more listings are coming, then the levels of active listings in comparison to transactions are high, you'll start to see prices come back down. People measure this in different ways: days of supply, inventory levels, ratios of supply to demand. It's all the same thing. Everyone just wants to sound different. So it's cool. It's up to us. It's the same with me sounding about inventory levels. Someone else might say it another way. But the truth is, it is how much deals are happening versus how many listings available. And if we're looking at some of the trends, Perth is extremely low. We're looking at just over 1.5 months of supply, 1.5 months of inventory. That means, hypothetically, if there was, say, 10 sales happening per month in Perth, there are only 15 properties available right now, which means that in 1.5 months, all those properties would be sold. So that is extremely tight. To give you a benchmark, when it hits around that 3 to 3.5 mark, it means that anything below that, prices are usually trending up. Now, you can hover under the 3 at 1.6, at 2.7, at 2. Don't look into that metric too much because seasonality can change that time of year, and even just certain trends that emerge but then disappear. Don't look into that too much. It's usually, if it's a clear trend from 2 to, say, 5, that's a clear sign of weakening markets. But right now, I would say that inventory levels are extremely tight in Perth. So there's low listings and high sales activity. The next thing is 10-year trends. With 10-year trends, we talked about price, but there's also active listings. Active listings from a 10-year levels are well below long-term averages, which means that there's, in some places, 30%, even other places up to 50% less properties for sale in comparison to how many properties there were for sale 3, 5, 6, 10 years ago. And because population is greater today, that makes an even greater impact because there's more people in the state, more people coming in, but there's less houses established available for sale than 3, 5, 7, 10. These are all clear trends that were emerging back in 2020. And if you'd like to see me where I pointed these trends out, just jump onto a Facebook group that I'm on regularly. It's called Property Talk Australia. And that Facebook group, you can just search me up, Arjun Paliwal Perth. And in that group, I talk about these trends in 2020 that were emerging with a strong rental market, strong trends showing that this market was going to have some strength there. Now, with regards to the trend of listings, that's clearly tight. So if there's not enough sales, there's high affordability, there is low inventory, and there is now fast selling, days on market's tight, these are all some of the trends that are coming together to say that the peak has not been reached and more activities there. The next one's vendor discounting. So looking at vendor discounting data, it's actually positive vendor discounting, which is interesting. It's very rare. It means that properties are almost always all over the place, selling for more than what they're listed for. So this is a clear activity that occurs when booms are placed. So you're looking at a listing price and thinking you're going to get a deal or discounted or negotiated below. Either that's just the agent making you feel like you have a chance and making you feel good so you can get the contract signed sooner, or you're just out of your mind. It's one of those two things. Most deals are going to be selling for more than what the listing actually says. And that's just a trend happening in Perth. So you want to be mindful of your comparable analysis as you're analyzing data so you can ensure you're avoiding those mistakes of overpaying and constantly getting it wrong. So looking at the 3 questions, I said, is this simply an investor-led boom where the demand moves in another market? The answer is no. There's a lot of investors' activity playing in that space, but it's not the core driver. It is one driver though, and it has to be considered, but it's not the core. Second is, can locals afford this market? The answer is yes. The affordability from an overvalued, undervalued is still quite strong. And then the third part is, what does the top of the market cycle look like? I shared with you that you can't use past growth alone in isolation. That is one component. It's important, but did it return to average? And no, it didn't. So it's still got numbers there. But even if it did return to average like Adelaide, it can go above average and then come back down. So it means that there are levels of growth to be had, even if it reaches there. We saw a low level of listings. We saw low levels of inventory. We saw fast levels of selling. And we also saw no vendor discounting. It's positive vendor discounting. So it's actually positive prices above listing. So when you put all this together, you're essentially saying that this combined with a strong job market means that there's years ahead for the Perth boom that's occurring right now. A key is now coming back to my original statement, which is going, hey, if this is a risk that you're comfortable with in the portfolio, because look, every market has volatility, but if you're comfortable with that, then it can definitely make sense as a market to invest in. But if you're not comfortable with that, then hey, there are other markets that have done just as well. And I've gone on and proved that, right? Adelaide was the best performing capital city for the last 4 years. So Adelaide doesn't have that component of its ups and downs, that depth of ups and downs. It's had periods of flat, don't get me wrong. It's had that between 2012 and 2019, but the 4 years of boom that's happened there are higher than what's happened in Perth over the last 4, yet it didn't have that economic part. And that's what I've always been big on. And same with Brisbane. So the key there is this: if you can constantly find markets that can have that same growth without you having to have that exposure, and actually you do that. But then if you feel like, no, I'd like exposure there because I've got markets across Queensland, SA, Vic, New South Wales, and you feel like I've got properties all over these markets, then this market's showing a strong growth cycle that's going to continue ahead. And I hope this answers your questions raised around, is it at its peak, where it's going to go? It's definitely not at its peak. It's got some more years to go. If you're watching this on YouTube, smash that like and subscribe button. I appreciate all the love you give in the comments, the likes, the subscribe. More content like this will keep coming your way. Now, if you're on Apple iTunes or Spotify, drop us a review. Look forward to reading them, checking them out, keep them flowing, and more podcasts like this will keep coming your way.